leverage. Some assets might have a 50 to 1 leverage. Some might have a 100 to 1 leverage. Some might have a 200 to 1 leverage. It just depends on the class. Stocks would have one. Cryptocurrencies would have a different one. Gold would have a different one. Other commodities would have a different one. But they're all predetermined. They're preset. And again, all of the brokers that are regulated are offering the same amount of leverage. So that being said, let's go talk about riding the volatility waves with Bollinger Bands. Now, Bollinger Bands are a very unique trading indicator. They were developed by John Bollinger, hence the name Bollinger Bands. Now, John Bollinger is still very, very active in the marketplace. It's very rare to have an indicator and have the developer or the mathematician or the person who developed the indicator still active in the market. Most of the time they've been developed 30, 40, 50 years ago. These people are retired, moved on, whatever else. But John Bollinger operates the Bollinger.com, and he's constantly being interviewed in the market, constantly talking about his asset. You can go over to I think it's www.bollingerbands.com and learn directly from the horse's mouth. So that makes it unique as it is. Now, there's been an abundance of information published on how to trade with Bollinger Bands. Now, much of it, though, is discretionary in theory. There's all these people out there who write articles about how to do this and how to do that and how to find the secrets of Bollinger Bands. You can read it all. There's not a problem. Okay. But most of it's kind of discretionary. There's some guy out there pushing his theory. Now, the how to use Bollinger Bands information usually pushes back to you, the trader, to interpret what the security price is doing relevant to the bands. Now, Bollinger Bands can be applied in all financial markets, including equities, Forex, commodities, cryptocurrency, futures. The nice thing about it, Bollinger Bands can be used in almost every time frame, from very, very short periods, because Bollinger Bands react very quickly on your charts. And therefore, for our type of trading, it is a great indicator. So first, before we go on, let me pop up a chart with Bollinger Bands on it so I can explain to you what they are if you don't know. So hold on, let me pop up a chart. I got one ready for you here. Okay, so we're looking at the live chart for the Euro US dollar. I haven't selected this for any other reason except this is my standard teaching chart. So I haven't selected the Euro US dollar because I'm making a recommendation about it tonight. I'm not. I teach from the Euro US dollar on this chart for every class. Now, right now I have the Bollinger Bands on the chart. Now you don't need to pay attention, or please don't pay attention to all my lines across the charts. These are my levels of support and resistance. They're color coded and keyed because this is how I've set them up. But they appear on all of my charts because they extend forever. Okay. The Bollinger Bands are the center band right here. So first, let's get this off my chart. So I've just clicked on the settings, and we're going to get off the upper band and the lower band in the background. And the only thing, let me make this a little bit bolder for you to see it better. Okay, the only thing I have on my chart right now is my candlesticks and this gold line. This gold line is a 20-period moving average. It is the center line and the basis for building your Bollinger Bands. Okay, so all Bollinger Bands are envelopes. They're these bands that go around price and form an envelope. Okay. The center of that envelope is always the 20-period moving average. And this envelope is based on a calculation called standard deviation, and the upper and the lower band of the Bollinger Bands is set at 2 standard deviations from the 20-period moving average. So what we have is the upper band and the lower band. These upper and lower bands are 2 standard deviations from the moving average line. Okay. Now we'll talk about standard deviation in a second. Now, Bollinger Bands makes all kinds of funny shapes. Sometimes it looks like a worm, sometimes it looks like a snake, sometimes it looks like a dragon. Okay. What it looks like is irrelevant to us. It doesn't tell us anything. The width of the bands does tell us something very, very important. When we see the bands widen, it tells us the markets are expanding their volatility. When the bands are narrow, it tells us volatility as at a low or is contracting. It doesn't tell us whether price is moving up or down, because see here we have an uptrend and the bands are staying relatively the same distance from each other. That's telling us because there's not volatility in the markets. Okay. Because an uptrend or a downtrend doesn't mean that there's volatility. Now here we have a move up and we had a lot of volatility. Here we had an extreme amount of volatility. Now, volatility plays a very important part of trading in several aspects. The more volatile the markets, the wider the price swings, the farther away you need to set your stop loss. And you also know as the volatility contracts and gets tighter and tighter, sooner or later there's going to be a breakout of that volatility. Okay. That breakout also offers you another opportunity. But before we talk about opportunities, we need to talk about these upper and the lower bands and their relationship to price and the relationship to the moving average. And to do that, we have to talk about standard deviation. Okay, and I know it's a complex issue. It's an involved mathematical calculation, and I know most people don't even want to think about it. Well, you never have to calculate it. Okay, but you need to understand it because it helps you understand and interpret the bands. So the bands are usually thought as employing a measure of central tendency as a base, such as a moving average. Okay, so we start in the moving average. Okay, and whereas the envelope covers the price structure without a clearly defined focus. Okay, these become bands as opposed to envelopes because they do have a defined structure, which is that moving average. So Bollinger Bands consists of a middle band, which is moving average, and the upper and the lower band. These upper and lower bands are set above and below the moving average by a certain number of standard deviation of price, thus incorporating the volatility into the band. The general principle is that by comparing a security's position relative to the bands, a trader may be able to determine if an asset price is wide, relatively low, or high. So we have to start with standard deviation. Now, interesting, in the real world, no statistician would ever calculate standard deviation by hand. The calculations involved are somewhat complex, and the risk of making a mistake is high. Also, calculated by hand is very slow. So, like I said, we never have to calculate it, but we need to understand it. So, standard deviation is a measure of the dispersion of a set of data from its mean. It's calculated as the square root of variance by determining the variation between each data point relative to the mean. If the data points are further from the mean, there is a higher deviation within the data set. Well, that was a mouthful, wasn't it? Okay, I'm going to ask you all very one time, because every time I get this message, it's usually because of the person listening. Can you all hear me okay? Because somebody wrote in and said unable to hear, and it's usually their own system, it's not mine. But Nobody else has complained. Can you just go into the question box and write in, I can hear you? It just help me along the way. Okay. You know, the first thing that everybody does instead of trying to check out their system, thank you all very, very, very much. Instead of trying to check out their system, they blame me. So let me. Okay, I answered them. Thanks, guys. Okay. Now, what I just said to you was a whole mouthful. Okay. And I really don't want to repeat it, but I want to explain it. So, in its simplest form, the mean is simply the moving average. Okay. The data points, what would they be? They would be the open, the high, the low, and the close. So if we were to take this definition, standard deviation is a measure of the dispersion of a set of data from its mean. Okay. So if we were to say that standard deviation is the distance between the moving average and the open, the moving average and the close, the moving average and the high, and the moving average and low for that specific time frame, that would give you the standard deviation. Because if the high was far away from the moving average and the close was close to the moving average, we have a different dispersion of that set of data. Now, what we do with that data once we get it, and we get the square root of the variance by determining the variation of each data point, all we're doing is doing a calculation that measures the difference between all of those points, the open, the high, the low, and the close, and the distance of the moving average, to give it to us in a relatively statistical format. So the higher the standard deviation is within a data set, the more volatility we have because price is moving far away from the high and the low, and it's quite volatile. So in its simplest form, the mean is simply the average of all data points in each set. In investing, for example, you might want to know the mean closing price. Let's throw the word mean out, and what is it? Average closing price for the last 20 days or last 20 periods. This can be obtained by adding the closing price for each session and dividing by 20, which is your moving average. Because markets are fickle at best, traders and analysts use moving averages to adjust to incorporate the most updated data. This mean as the calculation is always considered the most recent session's movements, and older sessions fall off. And therefore, we end up with the Bollinger Band. And the Bollinger Band is 2 standard deviations plus and 2 standard deviations minus from the moving average. Okay, that's it. And that's all you have to know. And by default, the Bollinger Bands are set at 2 standard deviations. Now, there are gurus out there who are telling you to use 2.5, some that tell you 1.5. John Bollinger developed with 2.0. Once you deviate from the 2.0, you then have to do your own calculation, not calculations, because today all the computer system will let you set it whatever you want to set that. But you then have to do your back checking to make sure that whatever formula you, not the mathematical code, but whatever strategy you're using works at a 1.5 or a 2.5 instead of the 2.0. So let's go back again to the live chart. Since I brought this issue up. Okay. In the settings, we can change our inputs and use a 10-period moving average or a 30-period moving average. Okay. But then it's no longer based on the standard Bollinger Band, and we would have to find out how price reacted to the change. We can also set it to a standard deviation, higher or lower, okay? And then it changes it also, but we would then have to back check it to make sure that whatever trading system we're using works well with that. Now, as I mentioned earlier, okay, one of the important things you have to learn about Bollinger Bands is, as you know, you can only trade moving forward because you can't make trades before this wall. You have a wall here, but all the trades you're going to make are in the future. So in order to use Bollinger Bands, you have to practice with them enough that when you see something happening, that you trust what's going to happen. So for instance, here we have very wide Bollinger Bands, and we know we have high volatility. We can look and see historically how the bands react to price. Not at the moment, because this isn't going to help us out. But like, for instance, this is called riding the band. Once you see price riding that band and price staying on that lower or the upper band, you have a trading opportunity. It is said, and it kind of holds true, that the trend of the price movement is not over until it breaks the moving average. So here, as price broke above the moving average, we had a good trend up. Here, now what we're also looking for, we don't care what's happening in the center here. We care about price and its reaction to the upper or the lower band. What we're looking for is rejection. You see how price came up here and it was rejected by that upper band. It could not stay above it or ride on it, so it started falling down. Here again, we see price rejected by the upper band. Okay. Coming down here, we see price rejected by the lower band. Now, here we get a rejection. We see price fall, but then we see price climb again. As you notice, it never broke the moving average. We wouldn't know that this uptrend, or we would say that this uptrend was not over until this point when it broke the moving average. Let me just clean this up a little bit here first. There are some other things about Bollinger Bands I'm going to briefly explain to you, but they don't fit into our style of trading. Now, you do have what we call patterns with Bollinger Bands, and these are called M and Ws. They're double tops or double bottoms. A double top or a double bottom takes a while to be formed, and first it forms an N, and then it would form the M, or in a reverse scenario, the W. It takes a long time, and they're very hard to see. They are reliable, except they don't work in our type of system, only because they take a very long time. It's just like anybody who's trying to trade with head and shoulders patterns. Head and shoulders in trading takes a very, very long time to develop. They're very reliable patterns, except again, for our type of trading, because we're trading in short-term increments. We only care where price is today relative to where it was a couple hours ago to where we think it might jump up to. Okay. We don't care what price was really 6 hours ago or yesterday. We're only talking about short-term trading now. So the M and W patterns for Bollinger Bands don't really work well for us. Now, Bollinger Band, John Bollinger, I don't know why I keep saying Bollinger, John Bollinger explains to us there's several ways to use Bollinger Bands. One of the ways is to use it for environmental studies, leaving your Bollinger Band on your chart and looking at it in a longer time frame to better understand what is happening in environmental level, where the pressure of the market might be coming from. Okay. So in this case, if we're looking at the Euro US dollar in a 4-hour chart, we can see the pressure is pushing up. The band is moving up. We have price riding above the moving average, but we don't have it riding on there, but it gives us an overall environmental understanding of the band. And then not making any of our trading decisions, we can then drop it to a shorter area and use this to make a determination of what we think price is going to be. Not for an entry and exit point, but if we set it down to a shorter period of time, what we can do is use the band to help us determine stop loss points and target points. The band doesn't really help us with entry points, okay? But it can help us figure out where our target price might be and where to place our stop loss so that we can calculate our right risk reward ratios to see even if we can make this trade. So hold on, let's go back to my PowerPoint for a second. So remember, you have the upper band, the lower band, and the middle band, which is your moving average. There are three primary uses for Bollinger Bands. One is pattern recognition. Double tops, head and shoulders, double bottoms. This is what I was mentioning, the M's and the W's. Okay. They also give us reversal signals. They help us give us an early warning sign when we might see a market reversal. It also helps us see the volatility in the markets. And lastly, it helps us do trend analysis by detecting the trend continuation or a conclusion of the trend. There are many ways to use Bollinger Bands, but it's important to notice that when the price touches the upper band, that doesn't automatically mean sell. Okay. Too many people say, when price reaches the upper band, sell, price reaches the lower band, buy. No. What you're looking at is rejection and the reaction of the upper and the lower band, and then the crossover of the moving average. So in fact, take it from John Bollinger himself, who said, there's absolutely nothing about a tag of a band that in and of itself is a signal to do anything. Now, price can walk the bands during a strong down or uptrend. This means that the prices are repeated instances that the price is touching or breaking through the upper or the lower band. Remember, I showed you on the chart. We can see price walking up the band or walking down that band. That's why you may not want to act when the price touches either band. And you might instead prefer to wait and look for a double bottom or a double top. But as long as price is riding that band and staying above the moving average, you most likely have that trend to continue. So this is the N and the M and the W. And I showed it to you on the live chart tonight, so I don't need to show it to you here. But this is the M and W where it makes the two equal bottoms while it's touching the lower band and then pushes up. If you notice here, it took 50 time frames to finish. Now, overall, we highly recommend combining Bollinger Bands with like the RSI indicator or stochastics, MACD, but with another indicator. Bollinger Band is just a piece of information. It's not a trading system, but you would use it to build a trading system, but it's just an informational tool. So matching with RSI is a perfect match. Now there's a preciseness using Bollinger Bands. Use this preciseness to your advantage. Bollinger Bands are a great indicator to use for any market. When you combine these with the RSI indicator, it should give you a high probability trades. So tonight, I just wanted to give you something to think about. Okay, there's no way you're going to learn to master Bollinger Bands in just a class. It's not a complicated indicator. It's easy to add it into your trading system. It's easy to make trades from, but it's only a tool that gives you a piece of information. But my suggestion would be is to add it into whatever you're looking at, because it's one of the few indicators that's actually dropped over price. As you know, most indicators are dropped on the lower end of your screen below price, down below. Bollinger Bands works directly with price. So you're reading what price tells you within a set of these bands. And this gives you a much better edge in the marketplace. So thank you very much for joining us tonight. I hope I gave you something to think about, and we'll talk to you again real soon. And thank you for supporting Alvexo. Good night now.